Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a financial mediator and business valuation expert in St. Louis. Today's topic is actually talking about strategic planning, investment banking, exit planning, and really, we just use these terms a little interchangeable, but letting the numbers speak and why exit planning isn't the same as investment banking with Luntadila Paulo. And he is an immigrant from Angola. He's Pan-African, global citizen, and an entrepreneur. He founded Yeto Accounting and Tax PLLC in 2019 to help small business owners minimize their taxes and basically get ready to sell and increase their net worth. And I want to welcome you. Thank you so much for being our guest.
Thank you so much. Thank you, Melissa. Yeah.
We've seen a lot of business brokers get into valuation credentials in order to do valuations in the process. But the reality
hmm
is, these deals are being done on cash flow and a multiple of
Yep.
cash flow, and the
Yep.
risk that the cash flow is going to continue in the perspective of the buyer, right? And
hmm
so if I
Yep.
perceive your business is risky,
hmm
I'm going to kind of like, oh, I don't know. Like, what are some of the things that are being perceived as risky in
hmm
in your opinion when you're going to
Yep.
market?
Yeah. Let me break this down, in terms of, the size of the company. Okay. Generally, companies generating less than $1 million in earnings have certain characteristics that make them significantly riskier than, let's say, businesses between 1 to 3 million in earnings, where a lot of private equity are actually playing the lower middle market. And then you'll have, over $3 to $10 million in earnings. But let's begin with the below $1 million in earnings. These companies are often a one man or one woman show. And that's, the owner is, if not the single largest risk factor in these companies, because they haven't managed to build two things: a management team and business systems around them. Let me add a little bit more detail here. In a management team, generally we expect to see a company being run by the CEO, the CFO, and the COO, right? The CFO manages the financial aspects of the company, the CEO, the operations. So let me go a little bit more detail there. So let's say we're talking about a steel erector business, right? We know the COO and the CFO are gonna be working hands on, making sure the supply chain is there, the raw materials are there, the production capacity is there, and the fulfillment of the service, right? And in some of these businesses, we might need to see somebody, as the head of sales, right? Somebody who brings client, who manages clients' relationships, and so forth. But in many businesses, in around less than $1 million in earnings, we don't see many of these figures around the owner of the company. The owner of the company deals with business development, clients relationship. They typically have an outside bookkeeper who handles their bookkeeping and their tax preparation. And the owner of the company is not necessarily expert in finance or in cash flow management or in bookkeeping or financial reporting. They do not know what they should be keeping track of in terms of their finances, so that eventually when somebody, arrives for due diligence, they're gonna be able to provide the type of granular details that is necessary to underwrite a deal, for example, right? And the owner is not doing that, right? On the system side, right? So I talked a little bit on the, your senior management side, but on the system side, we're not seeing, number one, governance in the firm, Many of these companies don't have a board of advisors or a board of directors, right? They don't have their business strategy laid out, written. It's only in the head of the business owner himself. Nobody else in the company knows where the business is going, what the goals of the companies are, what's the value, what the mission, what are the objectives, how the company creates value and manages value and delivers value to all of its shareholders, right? They do not have written policies, manuals, procedures, how we do things, how we bring clients, how we onboard clients, how we onboard employees or offboard employees, how we manufacture XYZ, right? So a lot of these details are missing. And when somebody comes and shows up, let me tell you a story. Recently, I received an email from a lady in New Jersey, and she said, "Hey, listen, I received a number of offer in the last 3 months, and I'm trying to figure out what way to go about it." And I replied to her, "Why don't we meet and talk about what you want?" Right? She said, "Sure." And then we connected. The next day, we connected in a call. So we started talking about what she really wanted and not necessarily what these offers were. And she ended up realizing that she not only wasn't ready for exit, but the business itself was not ready for exit because we have a list of just basic question we ask business owners, right? Do you have your last 12 months of your P&L? Do you have a balance sheet that reflects the accurate reality of your business, right? Do you have your tax returns filed in the last 3 years? Okay. Do you have contracts of all of your employees, current and former? Do you have any contract with any independent contractors, right? So as we started going down to that list, the more she became really concerned because the offer might look great on paper, but if you're not able to meet the due diligence, you're not going anywhere. You're not exiting. And even when you meet the due diligence, once they can start, checking your company, bringing the really good advisors, right? To your company to look into things, right? Whatever they find, that offer might end up looking significantly different to the one that you received at first, right? The deal structure piece is gonna be drastically different, and that's typically where we see a lot of deals dying because the seller was super excited with the initial offer they received, and they thought that's what I'm gonna walk away with, and then a 80% down payment end up becoming 30% or less down payment, earnouts, seller financing, okay, and a lot of clawbacks in the event what you told them the company will be making in the next 3 years doesn't materialize, right? So guess what? People get really sad and they just walk away from the deal table.